Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. So today I'm joined with Jason Crawshaw. How you doing, Jason?
Doing great. Thanks so much, Kirk, for having me. Appreciate it.
Good. Well, glad to have you in the show. I wanted to talk about this category because no one's paying attention to it, unfortunately, but that's why I want to bring Jason on so we could bring your attention to it. Jason, maybe you could tell us a bit about your background.
Sure, great. Thanks, Kirk. So I'm a portfolio manager here at Polaris Capital Management in Boston. I'm actually from South Africa originally. I'm sure my accent is long gone. Grew up in the US, but after graduating from business school, went back and worked in Johannesburg, and that's really where I cut my teeth in the equity market. It's been 30 years on now, bottoms up fundamental equity analysis. In fact, the first 20 years of my career has been actually in the long short world, which has certainly given me a little bit different perspective, looking for both winners and losers. And the last 10 or 11 years has been at Polaris, which is a long only global value shop.
Okay, cool. So tell me a little bit about your where your focus is now. Like what's your primary focus with investment management?
Yeah, so our strategy is a global value strategy. Our brand of value is different than probably most value managers, meaning that we only care about one thing, and that's cash flow generation. So we are discounted cash flow investors. What that means is we don't actually use free cash flow. We use this concept of maintenance cash flow, which is basically cash flow from operations minus maintenance CapEx. But we do it in real terms, meaning inflation adjusted. And what's really interesting is, I've been here 11 years, and for the first 10 years, no one really cared about real versus nominal because rates were so low. But clearly, over the last year and a half, given inflation has gone up, people are talking about real returns. In terms of what we're focused on, we are multi-cap managers. That means we invest in small, mid, and large cap. And we really focus in terms of building the portfolio from a bottoms-up perspective. We are looking for, in our global portfolio, the best 75 to 100 stocks anywhere in the world, any sector, any geography, completely benchmark agnostic. We're just looking for streams of cash flow that we can buy cheaply and are good capital allocators. And ultimately, to answer your question, what are we looking at now? I think international is the most interesting. As a global investor, I think we know that the U.S. certainly sort of dominates the equity markets right now. We've been underweight for the U.S. For some time just because we see so much better value in the international market. So that's where we're spending the bulk of our time.
What's interesting is, I mean, the US market is by market cap is what, 50, 60% of the global market?
In fact, it's even more than that. If you look at 60% maybe 5 years ago, I think it's upwards of 70% of the
Wow.
the MSCI world benchmark. And what's interesting is if you compare that to the US's global share of GDP, I think it's about 31%. So more than two times the economic share relative to market cap. And so now, admittedly, there's some fantastic companies in the U.S. There's a lot of things that, certainly from a structural perspective, favor the U.S. But it does seem, from a value investor's perspective, a fair amount of that is priced in. And I would argue that the opportunities in the international markets have been priced much more favorably.
So why do you think the US has such a large share of the global market by market cap, but why do you think people are still preferential to the US? I mean, even international people are investing here, which is part of the reason for the overvaluation.
Yeah, look, it's a great question, and it's really been probably the trend for the better part of the last 10 years. Look, admittedly, some of the best companies, particularly growth companies and technology companies in the world, are in the US, right? The reality is, if you look at, we all know the Magnificent Seven, we can argue about their valuations, but, they are fantastic companies growing. We sort of always sort of scratch our heads at some point because there's sort of this kind of thesis, a law of large numbers saying, the bigger you get, the harder it is to grow. But, we've got a handful of companies that actually in some respects are growing faster as they get bigger. And so, I think it's a combination of, some really attractive companies that have some very good secular tailwinds. I think from a competitive perspective, if you look at Europe, look, it doesn't have the same technology ecosystem. It doesn't have the same capital ecosystem. So there certainly are advantages I think that the US and the US companies have relative to other global peers. But again, I would just argue as value investors, we think that's, mostly in the price then some.
Yeah, let's talk about different parts of the world because I think it'd be helpful because I know
Yeah.
most people in the U.S. don't even realize there are things outside the U.S. borders, but there are other countries out there for all of you listeners.
Yeah.
So let's start with Europe because I see Europe interestingly, because there's certainly a lot of risks with the Ukraine conflict going on, and they don't have the same tech we have, and the economy is not quite the same, um, but it's certainly people have been talking about Europe being undervalued for years, and yet it still hasn't taken off. Like, what do you think's standing in its way, or maybe it's just a stagnant kind of economy? Like, what do you think?
Yeah, I think there's a couple of things there. I think in fairness, in general, Europe is economically challenged relative to other areas, right? And so that's definitely an overriding sort of top-down headwind. The other things that are definitely problematic, clearly, the energy situation really is an outset or an offtake of the Russian invasion of Ukraine. I would argue in some respects, though, that Europe has done a pretty good job in a fairly short period of time adapting to sort of the energy constraints and thinking about alternatives. Regulatory is always tough in Europe, right? I mean, you talk about the EU as a single body in some respects, but there are just a lot of moving pieces from a bureaucratic perspective that is a challenge for businesses. If you think about restructuring a company, right? It's a heck of a lot easier to restructure a company in terms of right sizing your workforce in the US than it would be in Germany, for example. And so, I think by and large, Europe as a whole is challenged, but that doesn't mean you can't find fantastic opportunities in Europe. And what's always interesting to us is it almost seems that there's at times this financial arbitrage between where a company is domiciled and listed relative to where the actual cash flows are. We have multiple examples of companies in our portfolios that really their business has nothing to do with Europe. They're global businesses, but they might be listed in London or Ireland or someplace else, and they just trade at a fraction of the multiple than you would in a U.S. market. So I think the message is, yes, Europe has a number of issues that I think we're all well aware of, but there are some really sort of diamonds in the rough that are completely overlooked by a lot of investors.
So, what are going to be some of the catalysts to cause these valuations to actually become not more attractive, but would actually start to rise in a sense that you'd actually want to invest it instead of them being stagnant? Like, what are the biggest catalysts you see?
Yeah, look, and this is a little bit more of a global comment, and maybe I'll use Japan as the most recent example. We've always maintained that, if the public markets don't recognize the value, something has to change. And a lot of that comes around capital allocation, meaning that if your stock is undervalued and you're a good cash flowing business and the public markets don't recognize it, you've got a couple of choices. You can either sell yourself, you can take yourself private, or you can return a lot of capital to shareholders, either in the form of a dividend or share buyback. And if I think about almost a catalyst as an example, and catalysts are tough because they're always sort of the obvious in hindsight. When people talk about forecasting catalysts, I think that's a crystal ball no clearer than anyone else's. But if you look at Japan for an example, right, there's an example of a 30-year bear market, for a lot of reasons, prior overvaluation, difficult demographics. But what's changed in Japan over the last 18 to 24 months? It's really been about capital allocation, meaning that Japanese companies for years and years and years didn't allocate capital wisely. And there's been a big push from a regulatory perspective, both from the government, both from the Tokyo Stock Exchange, to saying, look, you need to give more capital back to shareholders. And that's just been a very simple catalyst that's done wonders for the Japanese market. And so, even if I look at some of these companies in Europe, and we have multiple examples, we just say, look, if the market doesn't recognize the value, just keep buying back stock. And that's really what the message that we have to the management teams that we invest in. And so again, I don't think there's one specific catalyst that all of a sudden, the region or investors wake up and say, hey, I want to own Europe collectively. But there are things that are within companies' control that they can shape their own destiny.
Yeah, Japan's actually an interesting one because I mean, I've been following them for years. I think the stock market went down for like 25 years in a row until it finally started to head back in the right direction. And now it's at all-time highs. Although I would think the yen problem would be a potential issue. I mean, how do you see? I mean, I think Japan's an interesting case because they went through deflation for
Yeah.
a long period of time, a few decades, and then now the stock market's coming back, but now they have the yen problem. How do you think that's going to impact the Japanese stock market, even though they're shareholder friendly now, which is good, but the
Yeah,
yen
look,
probably
I
has
mean,
an
the
impact.
yen, yeah, I mean, you're 100% right. And look, it sort of touches on something that we wrestle with all the time. As global value investors, we always have to bring our returns back into dollars, right? So when we look at any market, whether it be Japan, Korea, Europe or Latin America, Africa, and the like, we always have to think about the currency component as well in terms of that return piece. And if you think about, not only has the U.S. basically had really good stock market performance, the dollar's been really strong in terms of probably over the past decade. Japan, we've seen the yen go from, call it 115. I think we're 157 today. I think initially a couple of things have happened, right? Certainly some of the big Japanese exporters, like any weakening currency in a country, would favor, export companies. And I guess it's not surprising that, Buffett made his foray into Japan into the kind of the five Japanese trading houses that are all very export oriented and have sort of global businesses. And so I think what you've seen in Japan today is certainly the exporters benefiting. Within that, I guess the question is, what next? Are we going to see 170, 180 on the yen? I don't think the BOJ really wants to see that. And we are in a period now of, rates, for the first time in a long time, starting to tick up because we are seeing a little bit of inflation. Plus, I think there are some concerns about the yen. So ultimately, the question will be, does the Japanese equity market, does it broaden out to more sort of domestic plays and the like? Certainly the Japanese consumer is under a fair amount of pressure because wage growth hasn't really gone up. Clearly the Japanese are finding it much more difficult to travel overseas. And so I think, domestic, despite the fact that the equity market has been really, really strong, I think domestic enthusiasm for the economy is still very soft. The question will be, though, is, with a different interest rate environment, will that change things? And so it does seem that Japan's probably in sort of broad market terms moved a little too far too quickly. But you also got to keep in mind it's a 30-year bear market, right? And when you have basically 30 years of underperformance like Japan has had, it's fairly unlikely that the bull market will be 18 to 24 months. So could be a little ahead of itself. We could see some other sectors, some of the financial sectors, for example, are starting to perform well in Japan. But again, the combination of a weaker yen for the exporters, but really just a fundamental change around corporate governance and capital allocation has really been the spark that's lit the fire in Japan.
Yeah, it's interesting. I wonder, at some point you were talking about how it impacts the export and the import part. It kind of makes me wonder. I mean, they're really like the biggest example of deflation in our global economy right now. And they've talked about raising interest rates, which I don't know how they do that. I mean, they have such a big debt load. I don't know how they
Yeah,
raise rates. Same problem that we have in the US. Like
yeah,
we have what, a third of our budget goes towards interest
sure.
payments, and
Yeah.
that's at close to 0% rates, and now we're at 5, and that's going to keep raising. So kind of makes me wonder, how they're going to be able to do that and still function as an economy. Um, but I guess I don't know if you have any further thoughts on that. We could kind of move to different countries, but
Yeah, look, I mean, I think it's an issue for almost all developed countries, right? Excessive debt loads, financed at much lower rates. I mean, use the example of the U.S. I mean, every time a treasury bill or bond matures, right, it's being refinanced at higher rates. We seem certainly in the U.S. have this, insatiable ability just to print money and borrow money, and that works until it doesn't. Look, I've probably been saying that for 10 years, and so far, I guess the Pollyanna has not proved to be correct. But again, I think it's a problem for the U.S. It's one of our longer term concerns. Certainly, the sustainability of deficit spending in almost any country. but it's not unique to Japan. We see it in almost every developed market.
Yeah. Yeah, and so that's, I mean, that's always kind of been my hang up with international is with all the potential like Japan, like the stock market going up, there's obviously still some issues there. Let's talk about emerging markets because I know for God,
Yeah,
it's got to be the last like at least 4 years, GMO, which publishes
yeah.
their report of evaluations, has come out, and it's always been international. I'm sorry, emerging value has always been like way up there, and yet emerging markets haven't been a rocket ship. And but let's talk about emerging markets a little bit, like where you see the opportunities, the risks.
Yeah, it's interesting. I'm going to kind of go back 20 years now because, I'm old enough to remember sort of, from 2000 and early from 2000 to 2010, people said, look, the only place you should ever invest are emerging markets because that's where the growth is. And why would you ever invest in developed markets, including the US? And that was really the rage, right? Clearly EM has been a very difficult sort of asset class for a number of years. And even within that, China's role in EM has been so meaningful that skewed things. And if we even to start with China as the example, right? 5 or 6 years ago, people loved China, right? It was the only place to invest because of, the rising middle class, obviously kind of all the kind of sort of economic kind of growth rates in China. And, like all things in life, conventional wisdom or sort of the crowd generally tends to be wrong, right? And so, China's gone from one of the most loved markets in the world to probably the most hated or one of the most sort of out of favor. And given its weight in EM, in a lot of respects, it's just dragged down most of EM. But, that would be consistent. If I kind of think about kind of EM across the world, there haven't been there haven't been really many great places to invest in EM for a number of reasons over the past 5 to 10 years. And again, a lot of it also has to do with the currencies, right? The US has been so strong relative to most emerging currencies that even when you take those returns back into dollars, it looks fairly paltry. What do we see now? It's interesting. So, we're bottoms up stock selectors, but what we do is we run sort of a front end sort of quantitative screen to effectively create the pool for us to fish in. And China has been consistently the second largest pool for us to pay attention to for the better part of 5 or 6 years. And that's just a function of, both the valuations there and the number of companies. Having said that, I think we've only owned one Chinese stock over the past 5 years. And the reason why is China has had been a little bit of a bifurcated market, right? Meaning that, all the interesting kind of westernized growing companies like Tencent and Alibaba were always too expensive for us as value investors to buy. And all the really cheap companies were sort of the banks or the state-owned enterprises or some of the industrial companies. What you've seen a little bit is all those sort of growthy tech Chinese companies, they've really borne the brunt of the kind of the devaluation in terms of multiple compression there. You are seeing, some China value stocks actually work a little bit. But, for us, I wouldn't say we're contrarian, but I'm sort of a believer it's never as good or as bad as it seems. It was never as good as it seemed in China. It's probably not as bad as it seems right now. In fact, we had two of our analysts there last month for a couple of weeks, just poking around the Chinese economy, seeing what's going on. I think that's definitely a market that, we could see some real opportunities. As I say, we don't own any Chinese stocks currently, but it certainly warrants more of our attention going forward.
Yeah, the China's always been interesting to me. I mean, I never really trusted much of the information out of China.
Yeah,
It was like, hey, we consistently have 7.5% inflation every year. It's like, yeah, okay. I mean, I know we exported our inflation to China, which is a big part of it,
yeah.
um, but now their regulatory administration, we'll call it, of the markets over there seems a little bit burdensome, in that I'm not sure that I would trust that maybe the CEO doesn't disappear overnight because he said something stupid, and
Yeah.
um, the they don't seem to. They were very entrepreneurial, supportive entrepreneurial endeavors over there until, what was it, a year ago, and then they just, or 2 years ago, and then they were very against it. It gives me pause to, okay, maybe that's not a safe environment to invest in.
Yeah, look, I wouldn't disagree with that. And I think, if you think about some of the high flyers that have sort of crashed to earth, it's really been, strokes of a pen in some respect, right? Changing in sort of, gambling or gaming regulation, or, there was sort of the kind of the canary in the coal mine where, the Chinese education stocks, I think, 18 months ago, a couple of years ago. And so, one of my colleagues here, is Chinese and from China. And he's probably the most skeptical of kind of the Chinese economy. And I would certainly concur in terms of the information flow. And look, at one of the reasons why we really haven't been heavy investors historically is, even if you look at kind of the numbers of a bank, do I really know what's in there? Do I know what's in the loan book? Do I know it's transparent? I mean, that's always been a huge obstacle.
Yeah.
But I think the broader point is you have to be ultra selective. You have to trade carefully. And, like all things in life, it's a question of, what's discounted in the price, right? And I would argue 5 years ago, when everyone believed, China, to your point of, 7% real GDP growth every year, gonna, take over the entirety of the economic world in some time frame, stocks were priced for that to happen in perpetuity. Things have changed, and now they're, I would, surmise, priced, far more attractively. But again, you have to be ultra selective because your observation is the right one. Things can change very quickly, and it's not the same rule of law. It's not the same, rules that we play by in some of the more developed markets.
Right. Yeah. It's like Russia. The stock exchange was closed up all of a sudden, and we have a conflict, and all the Russian ETF is no longer trading, even though it
Yep.
technically exists, and it's not zero, but it's also not able to take your money out.
That is true.
Um, so let me ask you this. So what about Africa? Because Africa is kind of a frontier market in some ways, and I mean, for decades people have been talking about it, but no one seems to. Um, the opportunities I've heard have been really interesting, but no one seems to be doing it in a major way. Um,
Yeah, look, so I mean, this is sort of, dear to my heart, given sort of my background. And I usually get to, South Africa once a year. And look, in South Africa is still the economic hub of Africa. And it's not, I wouldn't say where all the most exciting things are, but it's definitely still sort of the capital center. And you've got some really good companies in South Africa. Look, Africa is interesting for a couple of things. First, it's the only place with good demographics, right? And and maybe we'll get to this later in the discussion, but one of our longer term concerns for almost all countries, particularly developed, is really sort of the poor demographic structure. Africa, for all its issues, still has positive demographic population growth, which we think is important as a long term investor's perspective. Um, it's an interesting market in that the challenge is usually around the currency. Well, there are a number of challenges. It can be around currency, or it can be around governments. It can be around political stability, a number of things. But from an investor's perspective, usually the currency is probably the biggest impediment because by and large, unless you have a super commodity boom like you had kind of in the first part of the 2000s, most of the currencies generally tend to depreciate. So that's one challenge. In terms of the investment opportunities there, I would still argue South Africa certainly has the best companies. It has companies that reach up into Africa, so there's ways to play sort of Africa from that respect. The only other markets really, Nigeria is certainly a market that I'd looked at in the past. They've got big currency issues. There's not a lot of liquidity in that market. That's a bit of a challenge. And then the only other dynamic is that, Africa is an interesting place, particularly for multinationals and, really on the kind of the consumer side, the kind of the Coca-Colas of the world, or the Heineken, or the beverage companies. But the problem is it's just not a large enough part of those companies' businesses to move the needle. They're nice businesses. They're generally kind of high margin, high profitability. And so, in Africa, I think what I've generally observed is there are some good public companies that do avail themselves of opportunity, or where a lot of people make a lot of money in Africa is actually in the private business side, where there's just a lot of opportunities, gaps in the market. It's less competitive. There's inefficiencies that as a private operator, as an entrepreneur, you can do very, very well. But eventually, once you get scale and size, you run into some of the challenges around bureaucracy, regulation, government impediments, and the like. And so, good demographics, good opportunities, but just hard to play from an equity investor's perspective.
Yeah, it's what I find interesting is I've talked to a lot of people over the years. They find these great companies in, emerging markets, frontier markets, and just really amazing cash flows and all this, and the stocks just never follow pace. And even though they got good cash flow, just I don't know if it's just people don't care. It's kind of like investing in small caps or micro caps in the US.
Yeah.
Like,
Yeah.
just the volume just isn't there to drive the stock price back to where it should be. It's too small for the institutions. There's too few people there. But how does all that play into performance when it comes into international markets?
Yeah, look, I mean, I think again, what you speak to a little bit about good companies that stock prices just aren't performing. And, I guess what I hearken back to again, this is sort of a capital allocation sort of decision, meaning that, if you're producing a lot of cash flow and you're growing that cash flow stream and no one cares, well, you got to give it back to shareholders. And for example, in one of our funds, we have an international small cap fund. Historically, Taiwan, for example, has been quite an attractive place for us to invest. And the reason why is, there have been a lot of good companies. They're well managed, good technology, specific niches in terms of where they are in the value chain. And for years and years and years, they just produce a lot of cash and it would pile up in the balance sheet and no one would care. And then, what we saw happen, and again, this kind of speaks to a little bit of maybe what's happening in Japan is, the company said, you know what, if the market doesn't care, we're just going to start giving it back to shareholders. So you started to see Taiwanese companies with 5%, 6%, 7%, 8% sustainable dividend yields. And, once you start paying that out, not only, I mean, again, we're not in the business of just buying bonds and clipping coupons, but, once the investment proposition is, hey, at a bare minimum, I'm getting a 6 or 7% dividend yield, plus the company's growing, plus maybe, some other investors will start to care. All of a sudden, that has sort of a tremendous flywheel effect. And so, I think where valuations aren't being realized by the public markets, it's incumbent on management teams. If they want to realize value for shareholders, they really have to be thoughtful about the best way to do that. And by and large, that's usually returning capital to shareholders.
Okay. Yeah, I mean that obviously is always a good strategy, right? Buy back shares, dividends, pay down debt. A lot of the shareholder yield concept I'm a big fan of. So totally.
Hey, and Kirk, maybe another thing, just it's somewhat sort of tangential to this topic because what we've seen, and to your point earlier that small caps, micro caps sort of been left behind. We've been in this sort of unusual environment, particularly in international and to some extent the U.S. Really for the past 3 years, where you've seen extreme outperformance of large cap relative to small cap. And if I just use international as sort of the benchmark, over a 15 or 20-year period, small cap has outperformed large cap, and it should be. It should so because A, require a little bit of a premium for the liquidity discount, and B, small cap companies in general can grow more quickly than large cap. But just to put that in context, over the last 3 years in international, we've seen large cap outperform small cap by 800 basis point, 8% on an annual basis for the past 3 years, right? Which is really historic. And, the question I get all the time from our investors, given that, roughly half of our kind of multi-cap portfolio, small and mid, is, why do you think this is? Is this a new structural issue? Is this a secular change, or is this cyclical? And, one of the intuitive things I sort of think about is, we do this annual client event every January, and one of the slides we always have on up there is, how many of our companies are acquired, right? Because the companies that we invest in are, highly cash flow generative, they're cheap, and therefore they're generally very attractive acquisition targets for companies who want to buy, good companies at cheap prices. And every year in our global portfolio, we might have 5 to 10 companies that would be taken private, and they generally would be kind of the smaller cap companies. That shrunk from kind of 5 to 10 to maybe 1 or 2 a year, right? We're just not seeing the M&A activity in that small cap space that historically has been this realizer of value, this unlocking of value. Again, if the public market wouldn't recognize it, the private market would. Now, I've got a couple of theories why, and then we can talk about those. But I think the lack of M&A activity in small cap has led to this malaise. And historically, that's been a little bit of the fuel to the fire that's helped generate some of those returns in that asset class.
Yeah. So what are some of the other reasons? You mentioned that there's a few reasons there.
Yeah, look, I think the two reasons, and it's kind of sort of coincides. Let's just start with COVID, right? So, COVID was such an unusual event that COVID happens. Everyone's just trying to figure out how to manage their own business. You get remote workers. No one really knew what was going to happen, and so understandably, sort of M&A activity sort of really slowed down substantially as people just kind of work through, how do I get through whatever this is. And then what was interesting is, you started to come out of COVID, late, 2021 into 2022, and you did see sort of a little bit of a pickup and saying, okay, well, the sun's out, let's start doing some M&A activity, or let's see what opportunities out there. But then all of a sudden you had the rise in rates, right, or the beginning of the rise in rates. And you got to understand, as we've been in this low rate environment for a lot of years, which has led to a lot of interesting decisions from a lot of respects. And so, what we saw is, rates go from, call it 50 basis points to 500 in certain markets, certainly in the US. And so, the traditional buyers of these small cap companies historically have been private equity companies. They see these nicely cash flowing companies at cheap valuations. They take it private. Generally the companies that we invest in are lightly levered. They throw in some debt and they pay themselves a special dividend. Then it's sort of a little bit of a financial engineering. Now, the private equity guys, rely on cheap debt. And, with interest rates going higher, not only has their appetite to buy companies been curtailed, but they've had issues in their own portfolios. They've got a lot of refis and the like. And so the private equity buyer basically has stepped aside in the small cap space. I think the other dynamic is that the other source of acquisition historically has been other, strategic buyers, other public companies, private companies buying competitors. And that still makes sense. It probably makes more sense today than it would in the past. But I think the reason why you're also seeing hesitancy there is still just around this concern of when do rates stop going higher? What is my terminal rate assumption that I have to use when I basically make a bid for a company? And so I don't think you need lower rates for those buyers to come back. I think you just need an understanding that rates have probably peaked, and then people can bake that into whatever valuation multiple they want to pay for a company. And so I think to kind of cut to the chase, COVID certainly made people sort of reassess risk appetite. And then once sort of the animal spirits started to return, the change in the rate dynamic definitely took a lot of buyers out of the market. And I think what you'll need to see is at least some stability in rates until we start to see some of that activity return. And if we do, look, we've got companies that, could be taken private tomorrow that make, incredible sense for a number of buyers. We just need to see a little bit of activity to get the ball rolling.
Okay, cool. Well, we're going to wrap it up here in the interest of time, but one final question for you, which is, if you could only invest in one area, what would that be right now?
Look, certainly international. I think international value makes sense. And what's interesting is value versus growth in the international side is value is actually starting to perform on an international basis, not so in the US. And again, I think you want a multi-cap portfolio. If you wanted to tilt towards more small mid-cap, certainly given the dislocations we're seeing there. But I think international multi-cap is really what you want to think about. And someone who has both sort of an emerging market exposure, but again, developed markets seem to have some really, really attractive opportunities currently.
Okay. Awesome. Well, Jason, really appreciate you coming on the show. Where can people find more about you?
Yeah, look, so I think Polaris Capital Management is the firm I'm with. You can obviously go to our website. We also have something called the Polaris Global Value Fund, which again has its own dedicated website as well. So certainly feel free to look us up online. And we certainly always like to interface with our clients and prospective clients, and can definitely spend some time sharing more of our thoughts with anyone who's interested. So thank you, Kirk.
Awesome. Well, thanks for coming on the show, Jason. Thanks for sharing your wisdom with us. We'll probably have you back in the future because the world's not going to stop turning.
Okay. Appreciate it. Thanks so much. Enjoyed it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, that was a great interview with Jason. Really appreciate him coming on the show. Now we're into the panel portion of the show. We have our very own Megan Gorman. Hey, Megan.
Hey, Kirk, how you doing?
Good, yourself?
Good. Getting ready for
Great.
summer.
Awesome. Yeah, I'm getting ready for summer too. I'm looking forward to it. Had some great weather here in New England, and feels like California this week. So
Yeah. And remember, for people in our industry, we just want the markets to just stay flat. I'm not asking for a run up. I just want calm.
Yeah. We'll see what happens. Cross our fingers.
Exactly.
All right, and we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Happy to be here. Good to see you.
Yeah, glad to have you here as well. Well, let's just dive right in. So, Megan, what were some of your thoughts from the interview?
Yeah, I really enjoyed the interview. I'm a big advocate of having international and emerging markets in a portfolio. I think that we live in a global world, and you can't be US centric. And I think it brings an interesting opportunity set to a portfolio in terms of valuations. I think what really struck me in the interview, and he pointed it out at one point, is, most people don't realize that there are a lot of great companies all around the world that you would be remiss if you didn't try to get exposure to. And I think having international exposure is going to be important going forward. And it brings me back to when I got in the industry back in 2002. I don't know if you guys remember this investment debate, but the debate was the US and international decoupled? Do you remember the big decoupling debate of 20 years ago? And of course, the Great Recession showed us, no, we're not decoupled. And so that's going back to that, we aren't decoupled, but I think as we are in a global economy, I think it's also good to just make sure we're getting exposure to countries that are up and coming that might have even more growth than the US.
Yeah, those are great points. Phil, what about you? What are some of your thoughts?
I think international investing it could be a controversial topic because everybody has home country bias. Let's start there. So we're inclined as investors to invest in what we know, our country, wherever we live, but it's not the whole market. And then if we look over the last decade or more, the US has really outperformed. So it's made it even harder for people to think about investing internationally. But they forget that there was a period, just like everything else, these things have been in cycles historically. If you go back before that, you go back into the 90s and the 80s, you had times where international outperformed the US. So you can't always just invest in what's doing great today, because I always tell people it's not about beating the market when we're trying to invest. It's about investing in a way that allows you to live your life. And if we try to beat the market, we're taking on a lot of extra risk. The problem is, if we're right, that's great. But if we're wrong, you're going to be giving me that phone call that I never want to hear because you're really unhappy because you have these things that you want to do and you can't do them. So while the percentage may change, I always think that international should be part of a client portfolio. I think it's important to do that, to have that diversification in there.
Yeah, I agree. I think diversification is very important, and we're going to talk about that a little bit here. Here's a question for you. I mean, we have in the US we have home country bias. We all feel more comfortable investing in our own country, and yet the data also shows that every single person on the planet has home country bias. Or not every single person, but generally speaking, every country, the inhabitants have home country bias. Which is normal, right? You invest in what you know. The question is why should people invest outside their border, especially the US? I mean, most of our listeners are the US. We have some international people. But why should people invest outside the US when we're doing so much better than most countries in terms of returns for actually quite a long period of time? So Megan, I mean, why should people take that risk when you can invest in what you know here?
Yeah, two of the things I like to point out to clients is one, valuation, and two, dividends. So, when you look at the US markets compared to non-US markets, what you find is that non-US equities look a lot less expensive relative to pricier US holdings. And I think that's very, very important. But the second thing, which I think is important to investors, is yield. And when you think about it, what are you getting today in the S&P 500? 1.1%, 1.2%, right? I remember it used to be over 2%, right? And now one of the nice features of both international developed and emerging markets is you're being compensated to be in those markets. So we're seeing 3, 4, 5% dividend yields. And that's something that I think investors really like when they think big picture about the goals that they have from their portfolio. So those are two things I like to put forth with clients.
Okay. Yeah, it makes a lot of sense. What about you, Phil?
I love the point that Megan made about dividends. And part of the reason for that is that foreign investors look at stocks a little bit differently than we do. They want dividends. So companies there are more likely to pay dividends because of that. And here, we've gone into this mode where it's about total shareholder return. And so companies are buying back stock and we're looking at shareholder yield and counting the buybacks in it. But dividends add a level of discipline to a company too, because if a company says they're going to do a buyback and then they don't do it, the market doesn't really react to it. But if the company is paying you a dividend and they cut that dividend, that stock price gets cut. And dividend income, especially if you're a retiree, is really important because it allows you to not have to just sell stocks to fund your retirement. You can live off some of that income that you're getting. And I think that's really important. So that is something that you are going to get typically higher yields from the foreign stocks. So that is something that you definitely have to take into account.
I think Phil, like, and I'd be curious to hear both from you, both of you, and when you're doing your portfolio allocations. But when we're constructing both the international and emerging markets portfolio, we feel very strongly that this is not an area to index. And where's Barb when we need her for the debate today, right? And I want to just bring this up because, you know, there is a cost to going international, right? If you're not going to index. But I think it's very, very important to have active management in those areas. And in particular, we use a term a lot in investing, boots on the ground, right? You always hear people say, oh, they've got boots on the ground. But that was really important in these areas when you go back to things like the Russian invasion of Ukraine. A lot of these active managers who have boots on the ground started to see things going on in Russian banks leading up to the invasion, where they were stockpiling cash because they were anticipating, you know, embargoes from other countries. And so, you know, I think the thing is, when you go into the space, don't be afraid to do active management. Don't be afraid to really ask a lot of questions about how a manager does research. And then the last thing I'll say is, particularly with international developed, you want to make sure you have large company exposure and small company exposure. Because some of these smaller companies around the world are great at providing growth within the portfolio. And so I'm curious, Phil and Kirk, are you guys doing either active managers or more indexing in this space?
Go ahead, Phil.
So I will say that I'm more on the passive side, though I do have clients that have individual stocks. So certainly there is some active there, but that's where I'm picking it. But one thing that I will say too, that goes a little bit beyond or adds to that, is I also look at the impact of foreign currency. So while I might take passive, I am looking at a hedged approach. And if you look over the past few years, or the last 5, it's about even. But if you look over the last 1, 2, 3 years, that hedged portfolio has outperformed the unhedged. And I do, when I'm looking at those, I will include small caps too, because I agree with you that you do want to have small and large exposure. I get the boots on the ground concept, but I'm very sensitive to what the fees are that come with where I put my clients. And because of the fact that the fee structures on those are usually higher, I did have one that I tried and it didn't work well. So it's not like I would never do it, but I don't have the fund that I think fits my needs. And I also will tell you that from a tax perspective, I like ETFs much more than I like mutual funds. And on the ETF side, I think it gets a little bit harder too to find an actively managed international ETF.
Yeah, I think to Phil's point, you know, I've got a few rules that I kind of apply to ETF versus mutual fund approaches. You know, one is this. I mean, if you're investing in a large cap growth US fund, I'm not going to pick an active manager, right? I'm going to pick an index because the alpha is just not there, right? It's just not. Yeah, you can find some that deliver some alpha, but in general, you're not going to see that, right? So it's not worth paying for. However, if you're investing in high yield bonds, an index might not only be insufficient, but it might be problematic. Because if you look at high yield bonds, if we, during COVID, if we had the high yield bond route that we should have had, if the Fed didn't step in and back high yield bonds, we would have had an enormous route there. And in an index, that can be problematic. With active managers, they can manage that a little bit better, right? So there are certain asset classes that I think benefit from active management for various reasons. Another reason might be, as Phil was stating, you know, if you look at foreign ETFs, like international emerging markets, stuff like that, sometimes it's really hard for them to invest well, whether it's because the index is too big, or it could be because they're not nimble enough to have boots on the ground, right? Because a lot of ETFs are built top down; they're not built bottom up. They don't have people running around the streets saying, "Okay, well, which companies we can invest in?" They're saying, "All right, what is going to provide the most liquidity?" Right? If you look at ExxonMobil for years, it's been in almost every ETF because it's liquid, right? It's like, oh, it's in the green energy space, it's in the dirty energy space, it's in the growth, it's in the value. Like years ago, you could find that in almost any fund in any ETF because it was liquid. And I think, sometimes when indexes are constructed, it's not just for best performance, it's also for function. And if you look at, there used to be I believe a Cuba ETF, which was interesting. It was basically Cuba and the Caribbean. I looked it up just now and realized that that probably is no longer around because it looks like it's under a different moniker, same symbol. But basically it was like two companies that took up like 75% of the ETF or something crazy. And neither one of them Cuban companies. They were like Spanish companies. So it wasn't really a Cuba ETF or Caribbean. They had some exposure because those companies were allowed to go into Cuba. But my point is it wasn't really a functional ETF. There was also, I remember, an ETF that had it was for India. And I just looked it up, and it looks like either that's no longer around or it's changed. But at one point in time, I think there was 75%, it was like 50 or 75% of one company was in the India ETF, in one of these ETFs when it started. Now, realistically, if you were doing it based on size, market cap, that was deserved. But, obviously it's impractical. If I wanted to invest in that company, I'd invest in that company. So there's practical natures of ETFs that don't necessarily affect funds. So sometimes I'll give you another example. A friend of mine runs money in Europe. So he's got a Europe fund. He knows a lot of people. He does very well. But if you compare that to like a European ETF, right? And if you look at one of the bigger ones, you'll notice the performance is drastically different because he's actually going over there. He knows people. He's talking to people. These ETFs are just blanketing, like, what are the largest companies, we're going to invest in it, and that's that. And as a broad spectrum approach, that might be fine. But if you're trying to get alpha, which is basically the benefit above everyone else, then you're really looking for an active manager in certain areas. And I think that's kind of how I looked at it. It really just depended upon what I'm trying to do. If I'm trying to invest in something where it's broadly acceptable, or maybe there is no good fund manager that I like or could find, I might go with an ETF. So it's really dependent upon the options available in that area that I'm trying to invest in. That's how I look at it.
Can I add one thing to that too?
Yeah,
Is
please
that
do.
on the bond side, I think active can make even more of a difference, because I remember, and it's been a long time since I read this, but there was a time, if you're looking like at an emerging market bond fund and it's investing based upon some index, it's forced to take positions in these bonds. And the bonds can then get ridiculously mispriced because as people invest in that index or that ETF, they have to keep buying more. And I remember reading, and this was before Russia and Ukraine, but there's one of these bond funds and it owned these Russian bonds, and they had a lower yield than bonds in Wendy's. And if you think about the relative risk, that would make no sense. But because of how the index worked and because of how much money was in that ETF and the pressure that was put on them to then take those positions, it made those bonds very mispriced. So I think that's an area where if I was looking to invest in foreign bonds, I would definitely want to do that, because I would definitely want to look for something that was active as opposed to passive, because of those mispricings that can occur. So that's another consequence that can come in that passive world.
That's a great point, Phil. I think that's excellent. And if you look at the one thing I've always found amusing is people are buying bond ETFs. Right. There's so many reasons why you should do it and shouldn't do it. And I look at it and say, well, if people really understood, like, putting bonds in an ETF is in many ways problematic. You're trying to retain liquidity for illiquid asset. High yield bonds are even worse. And that was the whole point of the Fed stepping in after COVID was, high yield bonds are very illiquid. And you've got this liquid instrument holding illiquid instruments. I mean, what could possibly go wrong? So I think, there's a lot of pieces that I think most investors miss, which is well beyond whether it makes sense or not. It has to do with the operations and the function of the ETFs or the funds. And is it going to be problematic for you as an investor? Now, if you own the individual bonds, that's up to you, right? You know what you're getting. It's illiquid. You can, some of them are liquid, like treasuries are liquid, but it's different than just punching a button on and buying a stock. Sometimes, like perfect example, during the global financial crisis in 2008, when I forget which one it was, but one of the money market funds broke the buck. And that shouldn't happen, but it did because they were owning more or less illiquid assets in a liquid instrument. And they weren't illiquid except for when bad stuff starts to happen, and then they became illiquid, and now it's a problem. And so those things happen during crisis. So you should always be aware of what you're investing in, and is it going to be a problem in a crisis? Because if you expect it to not be a problem and it is, like investing in the Russia ETF and then all of a sudden it getting closed because you can't invest in it anymore. Oh, well, I don't know what's going to happen to that one, but you have to be aware of those things. You can't just go in and just say, oh, everything will be fine and I have no idea what I'm doing. You have to be aware that that illiquid investments inside of a liquid investment is very potentially problematic. But let's talk about some other things, because I want to get back to you, Phil, on this, because I know you've done a lot of work here. When you're investing in the U.S., we have a certain system. If you're doing fundamental investing, right? You're looking at the fundamentals, you're looking at the numbers, you're making assessment based on the company's math. But in some companies, the accounting's different, right? Or it's a little bit different. Like the accounting's technically the same, but they treat things differently in other countries. So how do you look at another country's math if they're not calculating things the same way the US does? Like how do you kind of square that?
That's a really good question. It's really hard because if I go back to the beginning of my career, I actually used to work in the international tax arena. But even though it was tax, we still had to look at financial statements. And there's different accounting rules, different accounting principles that apply. So you have to really be able to invest in those companies. And the reason that I'm not looking for a lot of, like I said, I will put individual stocks in portfolios. Not too many times are they going to be international because I know that I'm not as familiar with their accounting policies, and I can look at their statements and they're not telling me the same thing. Because like I remember there was a time when I worked in tax and I had a client that was a steel company and they had a joint venture with a Japanese company. And this joint venture was losing money. And the US company, which no longer exists, it wanted to end this joint venture or stop putting money in. And the Japanese partner kept saying, no, we got to put more money in, because the reason was, from the Japanese accounting perspective, as long as the value didn't go below zero, they didn't have to take a loss. So sure, let's put more money in because I don't have to declare this loss. But meanwhile, the US company is saying there, we got to put more money in, and it makes their losses bigger. So if you don't know that and those differences, it's really hard. That we can't have comparability becomes a lot harder when you're looking at companies where the accounting system's different. There are some standards that are more similar, but there are some differences. And if you're not aware of those, you're kind of blindly looking at financial statements thinking that they tell you the same thing, but they don't.
Yeah. It's an important metric to keep in mind for sure. So Megan, when you're looking at international for portfolios, how are you assessing what makes the most sense? Are you making sure you hit all of the areas, or are you looking at things like, let's say for China, for like the last, I don't know, year or two, or whatever it's been, where they've been kind of out of favor? Are you looking at areas and saying at some points we're not going to invest, or are you looking at it and saying, well, let's lighten up, or how do you assess foreign markets when sometimes they're just a bad place to be?
Yeah, I mean, so first of all, I have an investment team that does the due diligence, right? So for us to consider investment for the platform, we interview a number of different managers and do assessments to see if they warrant consideration. I think that, and I'll take emerging markets as a great example. I think that when we're looking at managers for our clients to invest with, we're looking to understand how they deal with strategy. So for instance, in emerging markets, we work with a manager who has a cautiousness when it comes to China. And what's been interesting in watching which countries he emphasizes in the portfolio, we've seen that he's been able to navigate around some of the challenges we've seen in the emerging markets in the last few years. So it's more about the diligence we do into the managers versus us being stock pickers. And we're constantly doing diligence. Just because we invest a client in a fund doesn't mean we stop meeting with the managers or understanding what they're doing in their underlying choices. And so that's probably more of an institutional approach to investing in international and emerging markets. I will say I do have a lot of clients who are also interested in the private markets. And so what's been interesting to see is, as you know, the private markets continue to expand, is how many, you know, private equity and venture capital funds are with exposure to Asia and Europe to get, you know, understanding of what type of startups they can get access to there. And I'm hopeful that as time goes on, we will start to see more investment opportunity sets in the private markets in regards to Africa, where I think it's incredibly interesting as a continent. I think the recent work done with the Biden administration and the president of Kenya on the East African Trade Agreement will be very, very important to the US in the next 20 years. So we anticipate to see a lot of startups and young companies in East Africa that might warrant investment consideration.
So here's a question for you, Megan. You know, if you think about, let's say, Africa, for instance, or even India, because I'm familiar with a story out of there. You know, if you look at places like that, where there are very few public opportunities, but there are a ton of private opportunities. Like India is a good example. Like they have a handful of big public companies, but they've got a ton of small private companies that are just gushing cash, and there's no way for people like us to invest in them. So how should kind of the average investor look at this as an opportunity, or should they? Maybe it's just something they shouldn't even look at.
Yeah, I mean, I think the thing is, you're picking a manager typically to make the investment decisions for you. So I think it's a bit of, what is your due diligence process? And I think in listening to things that you've said and Phil said, and the things that I've been talking about, what we're really saying to people out there who want to invest in international emerging markets is have a process and a strategy, right? In terms of how you want to approach this. And I think there's a lot of great tools out there. You know, Morningstar is one of those tools that I think all investors should at least get some exposure to in understanding what the underlying investments are in. So, I mean, I think it's difficult to, you know, give one little piece of advice. I think it's more, what is your process for accessing that area of the market? And what are you willing to pay to gain access to that area of the market?
Yeah, no, that's a great point. All right, so let's as we kind of wrap it up here, final thoughts here on investing internationally. Phil, what can we leave people here for some practical takeaways?
I guess the most important thing to me is don't leave it out. Include international. I know that you're going to say, I'm from the US. I know these companies better. It's performed better over the last 10 to 20 years. But there are great companies outside the US. It is important to have exposure to them. Not all, you know, the tide, a rising tide doesn't lift all boats, right? So you don't want to leave something out and leave out an opportunity set completely out of your portfolio. It doesn't make sense to me. We want to have a diversified investment approach. That's really important. And having international is part of that diversified investment approach, just like having fixed income. You know, like Megan said, the process is so important. Like to me, the process is the most important thing, because if we don't have a process that we stick to, it's really hard to figure out when we're unsuccessful, what caused it. If we're always changing what we're doing, we're not going to know why. We're not going to have a good idea why, and we're not going to be able to learn, because part of this is learning too, right? Because we all make mistakes. So we want to be able to learn from our mistakes. We want to be able to learn when we've made a bad choice. What is it that went wrong? And when you're looking at investment choices, I love that Megan mentioned Morningstar. I use it too, because I use that to try and understand what their process is. How do they go about? Because if you have above the basic level Morningstar service, they'll tell you what their process is, how they invest, how they select companies, because that's part of knowing, like, do you like their process? Does their process make sense to you? So just like we should have a process, whoever you're investing in, you want to make sure that they have a process. If you're not picking companies yourself and you're picking funds, make sure you understand the process and have a plan, and don't be leaving, to me, don't leave things out. You know, when I put together a portfolio in the US, I have large, mid, and small caps, right? When I invest in international, I have large and small caps. I'm not leaving that. I include emerging markets because I think there's opportunities for growth there. So you just want to make sure that you give yourself the best chance to get average returns. You know, average returns over a long time are really good, right? You don't have to outperform. If you just can get average returns over a period of time, you're going to outperform a lot of people. So don't sit there trying to time either. Just sit there and have a process and follow it and stick to it.
Where can people find more about you, Phil?
So for me, I know that experiencing big life transitions can be stressful, and my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook, and you can also sign up for our blog. Thanks for having me today, Kirk. Enjoyed the discussion.
Yeah, thanks for coming on, Phil. Megan, final thoughts from you.
Yeah, I mean, I echo a lot of what Phil said. I think that one of the big things just to remember in the process is, do you want to be passive in the international and emerging exposure, or do you want to be active? And really think through that decision. And then the other thing is, think about the role this is going to play, particularly if you're retired or need income from the portfolio. It's a great way to create a dividend income stream. So I'm Megan Gorman. You can find me at allthepresidentsmoney.com. That's my new book that's out September 24th. And in the book, we do talk about international investing because Herbert Hoover made his money in Australia and Asia. So he did well in international investing. So, and it's also available for pre-order on Amazon. Kirk, thanks for having me on.
Thanks for coming on, Megan, and check out Megan's book. Can't wait to read it. So thanks for joining us. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.